This is a basic tutorial on bookkeeping and double entry accounting and QuickBooks Pro 2019. Second half of this video is going to be about QuickBooks, putting all this stuff in. But we're not going to use spreadsheets here. That's not how we're learning. We're going to use visual tools like the scale, for example. Yay! And we're also going to help you learn by taking a little journey through history. We're going to create a little fictional character. So you ready? Let's go. I'm a cheese merchant somewhere in the middle of Italy, about 600 years ago-ish. And I sit here and I sell my cheeses. People come over there. I set the cheese here and I set the counterweights over here. And if it's off a little bit, I use this dialing up system up here. There's a 0 and some hash marks you see. So just weighing a piece of cheese like this, for example, weighs about 42 grams. But back then they called them scruples, I think, units of mass. So I'm selling my cheese. I'm getting bored. I've been doing this for 20 years. I want to hire somebody, but I can't because I can't trust them with the cash. I got no system of documentation. I just have my little box here where I keep the florin in, and I sell my cheese. Not only that, but then about a week ago, the tax man from the emperor comes up and he says, "Emperor's going to start taxing you." So I'm looking at the other merchants up and down the street, and I'm thinking to myself as they are, how are you going to do that? You come up this road once a month. You have no idea what's going on in these cash boxes. And he tells us they've got something called the double entry system, and they're going to be using that. And he says, it's not that complicated, really. There's only about 2 things you really got to know about it. The first is this little thing here. It's called a T account. I'll give you 3 guesses as to why it's called a T account. Very funny, I said. He said the other thing is this, what's called the accounting equation. This right here. Assets equals equity plus liability. That's all you need to know. So I said, well, okay, but can you explain this to me? I have no idea what that means. He says, simple. You got a house, right? I said, yeah. He says, okay, how much equity do you have in that house? I know what he's asking. I said, I own about half of it. He said, very good. So he picks up something like this, and he said, well, this is your asset, this is your home, the whole thing. It's equal to the sum of what you own and what somebody else owns. This is your equity, this is your liability. You add them together, you get the asset. That's what this formula is. I thought about it for a second and I thought, well, but you asked me what my equity is. So the way I think of it is I think if I see my house, the whole thing, and I take away what I owe, and it leaves me with my equity. So the equity is equal to the whole thing minus the liability on the bottom. So wouldn't it be more intuitive to write it like that? With the minus sign right there, asset minus liability. He says, well, you could think of it like that, but you'd be the only one. Everybody else remembers it like this, and you're going to remember it like this. Okay, I said, whatever. Let's get back to those T accounts. So he says, all right, you collect money. Let's say you sell a piece of cheese. You put the money in the cash box. You got to write it down somewhere. So you write it down in your cash T account, it's called. Just write down a number. This thing here, it's sitting right next to your cash box. Write down a number here. Since this is double entry, though, you have to write it down a second time. And you're going to write that down in this T account. Okay, let's say, he says, let's say you sell a piece of cheese for 3 florin. So you write it down in the cash T account. You write the same number down, it's always the same number, in the revenue account. Now notice, this is a mirrored image. You're always writing it as a mirrored image. And I said, well, okay, but how do I know which side to write the number on? Both sides look the same to me. That's right, he says. Remember, the cash account always looks like this. There's always an up arrow on the left side of the cash account. For everybody up and down the street, all these merchants, it's always the same. The left side of the cash account has an up arrow on it. Since you took in 3 florin, you put it in your cash box, you've fattened this account, you've added money to it, the account value goes up. You put the 3 in that area. Now on the revenue side, the right arrow always points up. Again, it's all the same for all the merchants in the revenue T account. They got the up arrow on the right side. So you got your recording and your mirrored recording. And I asked him, I said, okay, is that all I do? And he says, well, no, you're going to be using some more T accounts. For a guy like you, a cheese merchant, you probably use about 12 of them. 12, 13 maybe? I said, okay, so what do those T accounts look like? And he says, well, let me show you. I'll be right back. One more thing, the taxman says. Before I show you that map, I'm going to show you some T accounts. There's going to be some T accounts of these 12, 13 T accounts. Some of these T accounts are going to be associated with real things, tangible things. For example, you got one for your inventory, you know, the cheese out back, got another one for your property and so forth. But a few of these T accounts are created and they're not associated with anything. So they're abstract. And they're there because, we'll be honest, it's just a way of the emperor to keep an eye on you. It's you fulfilling your promise to the emperor to write every transaction down twice. I'll be right back. And then he says, see what I did for you here? I mapped it all out for you. I'm not sure if this is exactly what you're going to need, these accounts, but it's going to be very similar. Everybody up and down the street, all these merchants, they're going to have their T accounts arranged maybe a little bit different than you. But for a cheese account, for a cheese merchant, this probably worked pretty well. You see what I did here? I used your scale. You know where your scale is, right? Remember the formula? This formula you got to remember? Well, let's pretend, because you got your scale there anyway, we're just going to marry it to your scale. This assets here, we're going to put all the assets in this thing here. Remember your hash marks, your needle up top. We're going to make that the equity zone. And the third zone we're going to use is the liability zone. So that pan over on the other side, that's where you put all the ugly stuff, like your debts and things like that. You owe the cheese supplier, don't you? Well, you got to write that down. It goes in one of those T accounts over there on the ugly side over there. So that's how this works. Okay, now this game only has 3 rules. First rule, you enter each number twice, and it must be a mirrored image. Second rule, it never can be in the same account. It's got to be 2 unique accounts, but any 2 accounts. It can be both in the same asset, and both of them in assets, or one can be in the asset, the other one can be equity, etc. And the third rule is you can't use negative numbers. Okay, so remember, we've got the cash account, we've got the revenue account up there in equity. Remember how we did that a minute ago? Somebody bought some cheese from you, you put some money in the cash box, you made a mark in the cash T account, you had to record the other T account revenue on the opposite side. Left side of cash, right side of revenue. There's other kinds of transactions that go on with running a business. You may have to buy some cheese from a farm. How do you handle that? Well, you got to take some money out of your cash box, give it to the farmer, and you've got to record that as an expense. That's of an equity also. So in that case, you'd use the right side of the cash box and the left side of the expense box. Notice how the expense up there goes up because it's an expense. The left arrow in the expense T account is pointing upward. Now notice on the right side of the T account it's a dotted line. That's a reminder that you probably you won't be recording anything on that side of the expense account. Anyway, that's how it works. So getting back to that negative number thing, that's really what the liability side is for, is to handle those bad numbers, those ugly, icky numbers. Okay, now also keep in mind, you got a cash box here, don't you? Well, guess what? Now you got 2 cash boxes in your location. One's on the other side, called taxes. It's what you're going to have to pay the emperor. So throughout the day, weeks, months, you're putting money in that box. And I thought about it, I can't do that. People's going to steal it over there. And he says, you'll work it out. So those are liabilities. So let's get to QuickBooks, let's fire up a company, and get started, and then we'll come back to this map and talk about it more. We're going to jump back and forth. Ready? Okay, so we are exiting our scenario and coming into today. And we're going to start up a construction company. Clicking on Create a New Company on the lower left button. Since I had to create an email address to activate my QuickBooks for PC, now it's asking me again to log in to allow the creation of a company, and you'll have to do the same. With this drop-down box, you see the option to set on behalf of someone else. Just click on it for now, because the advanced setup options can be revisited after setup. We need a company name, so we're going to call this Jim's Company for now. Next, we're going with construction trades. Sole proprietor, business address, no thank you on the new feature tour for now. This is QuickBooks home screen, and you'll be seeing this a lot. So, the idea is that most of what was done back in Rome with double entry accounting is still valid here in QuickBooks. So we're bringing these three things with us into the present, those being the scale, the T accounts, and the accounting equation. And the scale, we're bringing it as a visual mnemonic memory device. Is the whole purpose. After you create your company, and assuming you're a construction contractor, though you don't have to be, we're going to need to enter customers' basic information. So let's create one before we start touching on the T accounts. So up top on the menu bar, you'll see Customers. Click that and select Customer Center. Just below that, you'll see New Customer and Job. Left click and enter a name, and it's helpful for this tutorial to also enter a customer phone, email address, and mailing address. Shipping also. And we're going to pretend that Mary, our client, wants 2 projects done, so each project must be entered individually. So while we're still in the customer center and have Mary's name highlighted, go ahead up to New Customer Job, and drop-down menu click Add Job. So for the first job, name it Demolition Deck. Click OK. And then drop it down again and click again Add Job. This will name New Deck. So we're going to create an estimate for each of these jobs, and QuickBooks has an icon on the home screen for that on the left here. Click on it and it opens up the estimate form for you to use. So go to Customer Job and find the job you've already created and are now creating an estimate for. In the description, type in Demolish Old Deck. Then under the Item drop-down, choose Demo. And for this, we're charging $500 with no haul-off of debris. This job is only labor. So let's do the estimate on the second job while we're here. This time the item will be, there's an item called Exterior Trim and Decks, and in description, type in Build Deck. And this one we're charging $15,000 for. You can make notes down in the text fields below. We want to remind the client that our company wants a third down on this job. This is a form that will be printed out to give to the clients. Oops, I forgot to choose Customer Job up top. Do that. Click Save. I need to pause here and talk about 2 things quickly. The first is that at this point, I'm going to assume that you figured out that you need a business checking account because that's what is needed here in QuickBooks to continue. I mean, you can operate with cash only effectively here, and QuickBooks really doesn't differentiate much between a cash shoebox and a business checking account. The transactions are pretty much identical, but you're going to need a business checking account, get real.
And the second thing is that you need to talk to your CPA on whether or not to use the cash or accrual method here in QuickBooks, and it's a simple button click and edit preferences. How does QuickBooks display the scale and the map of T accounts? Go up here to Lists and click the chart of accounts. That's more formal way of saying our map of T accounts. Here it is, and it's displayed as a spreadsheet. Yuck, but okay, we'll get used to that. These top four here are asset accounts in that they are the left side of the accounting equation. As you can see in this right column here, they don't say asset, but they are. The next two are liabilities. One says accounts payable, and the next says payroll liabilities. Of course, this is a generic list that you'll be modifying. You may or may not have employees for this payroll liabilities T account. And traveling further down the list, we get into the equity accounts all grouped together. In the right column, you'll see cost of goods sold. For short, it's COGS. And then below that are the expense accounts. And both of these types of groups are found within the equity part of the accounting equation, at least according to QuickBooks. Now, the left column are the names of these T accounts, right? And these names can change, like if you can create and delete and add and edit and so forth, according to what your CPA recommends, or your discretion, I suppose, as long as they follow GAAP. Every T account here is part of the double entry system, which again means that when you make an entry into one of these, you have to choose a second one to enter that mirrored entry. So let's get back to that ancient map and update it.
So here's an updated map or chart of accounts, and you'll need to modify yours to look something similar to this with the help of your CPA, of course. If you're a sole proprietor, construction contractor. Notice we replaced a cash account with a business checking account, and as a primary source of cash flow, and also a T account called undeposited funds will prove to be a handy T account in the assets section. In equity, we've added something called COGS, which is cost of goods sold, which is an expense account. And according to QuickBooks, in the manner that you will be using it, it's what you'll be using to purchase materials. For example, you're going to take some money out of your checking account, and so you use the right side of your business checking account and the left side of your COGS account. That's where you will record that amount of any purchase. And then in the liability zone, we've added customer down payment, and you might use a T account called credit card because it's on the nasty, ugly side over there. But I didn't want to talk about that yet because then you have interest and it gets kind of complicated. So, but if you do use a credit card, it's going to be a T account over there. QuickBooks will allow you to use credit cards, and it's very good about that to set that up. So what about these arrows? How do you remember in your head? How do you get an intuition for how these arrows go? Because it's good to, if you're a bookkeeper, it is good to understand intuitively the nature of the direction of the arrows. And so if you'll notice on the asset account, the left side, the arrows all go up, and on the right side, the liability, the arrows all go up. So this is a little picture of a cat climbing up a tree, and it's on the extreme outside of this map here. From my understanding, cats are good at climbing up, not so good at climbing down. And then on the other side, if you can recognize that, that's a picture of the Empire State Building. And there's a little spot on the outside of it, and it's King Kong climbing up from the old 33 movie. King Kong climbed up, and then he didn't climb back down, he fell down. So that's how I remember that the outsides always have arrows pointing up. Or another way to remember it is just maybe take this above your monitor. So you got an arrow on the outside and an arrow on the outside. So that's 2/3 of the arrows, the assets and the liabilities. What about the equity? Is there a way to remember those? Well, you're going to have to use an anchor, this business checking account. It's the one, you could also call it your cash account if you're operating like that, but it's a good one to anchor to when you're trying to figure out what's what up above. For example, if you're putting money in owner's capital is another way of saying owner's equity. It's the same thing. QuickBooks uses the word equity. So if you're investing in your company, you're putting money in the business checking account. And it's going up, so it's on the left side. So on the right side of your owner's capital, owner's equity, it's also going up. So that's how you remember that. Oh yeah, it's on the right side, it goes up. What about the owner's draw? Well, the right side of the business checking going down. So the left side of the owner's draw is going up. And that's how you remember. So you use the business checking to deduce the arrows up there in equity. And that's how you remember it.
Back to QuickBooks here, and we're going to now modify the chart of account to be more like our map of accounts. Go to Lists and then drop down, click Chart of Accounts. So we have to customize this to Jim's needs, and so we will create the accounts to match our scale map. Go down to the bottom and click Account and then New. And we're going to go ahead and start with a bank account. QuickBooks knows this is an asset account. It'll assign that for us. Click Continue. It wants a name for this checking account, so we're going to do business checking and then a description, business checking also. Click Save and Close. And it's going to prompt us here if we want to sync with a bank, and we're going to deny that. We'll move on with that. So then we're going to move on down and do another T account. So click New again. And this time we are going to go with, let me see, a fixed asset. And this one will be the property one. Not necessarily that you'll have property, but just to put it in there. Click New, or Save rather. And then again, keep going. New. This is going to be other current liability. We're going to do the customer down payment. This is assuming small contractors often take down payments, so we're going to need something like this. This is a T account in liability that we talked about on the scale map. The next thing that Jim needs to do is to make an initial capital deposit in his new business checking account. As we mentioned a few minutes ago, the second account affected will be the owner's capital account, also known as the owner's equity account, as QuickBooks prefers to call it. Since the money is raising the value of the business checking, that means it must go on the left side. And therefore the mirrored input must be on the right side of the owner's capital T account. And as you can see, the arrow in that account is always pointing up on the right side, so everything is kosher. Now let's do this in QuickBooks and deposit, say, $10,000. So we're going over here and clicking on this Make Deposit icon on the home screen, and it brings up this dialog window. As you see up top, it says Deposit to Business Check. So QuickBooks already knows the first T account, but what about the second T account? The owner's capital account. You have to choose it from this drop down here called From Account. And I got to tell you, I honestly have no idea why QuickBooks says that, because it implies all sorts of strange options when we just want to make an owner's initial investment. So yeah, it's a little confusing here until you just get used to it. Anyway, this is where you select the second T account, and as we scroll down here looking for either the owner's equity or owner's capital, which mean the same thing, I see that I have forgotten about this one here, the initial investment T account that we're supposed to use. Oops. This is a one-time T account that we'll use, and then your CPA will know what to do with whatever you put in here, whatever amount you put in there. It has the same arrow structure and location as the owner's equity account. So it's the right thing to do. And then later when you make further investments, that's when you go to your normal owner's equity T account like we just discussed. Here we put in what entity is the source of the money, be it client or owner or whatever. sole proprietor Jim. A little memo never hurts. We're going to use a check from Jim's personal account, and we're depositing $10,000. So to verify that we did this right, go up to Lists and drop down and click Chart of Accounts. And as you can see up here, that QuickBooks successfully recorded the amount in the two correct T accounts. While we're here, let's double click on the business checking line and therefore drill into and show how QuickBooks displays that business checking T account. It's also called the check registry, and you'll be seeing a lot of this, and there are many ways to enter the check registry, which you will discover. It's also an icon in your face on the home screen. Notice how the bank displays the amount in the wrong column. That's because the bank sees you as a liability, I guess. So close the check registry, and we still have the chart of accounts open here. So let's run on down to that one-time opening balance equity T account and drill into it. And we also have a register, except just a slightly different color than the business checking register we were just in. And you can see that the 10K has been recorded. And close that. And what I want to show you next is how to use the kind of Swiss Army knife of double entering dollar amounts. It's called the General Journal. So I'm going to show you another way to do that, exactly what we just did, because you're going to have to become familiar with this Swiss Army knife pretty quick here. So in order to show you that, I first need to delete what I just did so I can re-enter. The way you do that is to drill back into the business checking account and right-click on the deposit line and click Delete Deposit. So QuickBooks is pretty smart, and so notice how it knew to also make disappear the mirrored entry in the one-time opening balance equity T account. If you look at the right, the balance on that T account is now 0. And so now going after our Swiss Army knife, formerly named the General Journal, move up to the company drop-down, and about 3/4 of the way down is Make General Journal Entries. Click that. Close the unimportant dialog box. This is the interface, and we can choose any T account here. We're going to start with business checking, and we're adding 10,000, so insert it in the debit column, because right next to it is the credit column, and those two words are associated with the left and right side of a T account. That's why you need to remember the arrows so you remember which side to choose here. QuickBooks allows you to go to whatever side you want here in the General Journal because it doesn't know any better until you populate one side. Now moving down a line, and QuickBooks knows the mirror rule too, so it auto-populates the right column of the next chosen T account even though you haven't even chosen one yet. So now we're free to choose a second T account, and we're going to scroll down to Opening Balance Equity. This is a journal entry and needs to be assigned a journal entry number, like number 1, etc. So I'm just letting QuickBooks assign one. And notations within each journal entry is always a good idea. Farther to the right is a drop-down menu under the field called Name. And we're leaving it blank because it's just QuickBooks asking us if this is an entry to be associated with a particular job, which it's not. Let's just reassure ourselves that the General Journal entry did what it was supposed to do by visiting our 2 T accounts. So while still in the Chart of Accounts dialog box, we will again double-click on the business checking. Everything looks good here, nothing strange, so close that. Then double-click on the Opening Balance Equity, and that account opens, and everything here is correct as well. Moving on, let's proceed with the first job. Mary's accepted Jim's estimate, and Jim does the work and then needs to get paid. We will learn to invoice in a minute, but for the sake of clarity, let's just pretend Jim was paid at the end of the day and no invoice was issued to Mary, because we just want to see first how to handle the money, because honestly that's the important thing here. He should record this payment as a transaction and use the 2 accounts of revenue and business checking as long as he deposits the check immediately. So handling this transaction in QuickBooks, we would normally move along this horizontal line starting with this estimate. So open it up to remind us what we presented Mary with. So we can close this because it's just telling us to charge $500. But then we could easily create an invoice from what's inside the estimate if we wanted. Then receive payment. Then record deposit. This is normal workflow for most businesses, but we're going to jump over the middle two icons here and just go right to the record deposit for now without ever tapping into the estimate amount. Clicking on the record deposit icon opens it up, and we see this make deposit form we had open a few minutes ago. Since it automatically defaulted to your business checking account up top, we just need to tell it what the source is first under received from. In this case, it's from Mary, but it's also being linked to a job. And then here under the from account is where we tell it what the second T account is. And remember that since QuickBooks knows we are depositing money into the business checking account, it knows to record that amount on the left side of the business T account and the right side of whatever account we choose. In this instant, we choose revenue, also known as job income. It never hurts to attach text to a transaction. Tell it cash, and enter the amount. Let's get back into the chart of accounts again to verify again. Double-click business checking. You see the $500 is in there. Close this and double-check on job income, and you see the money is in there. Notice this isn't presented in the form of a register like the checking account looks, but it still is a T account. It's just that QuickBooks treats it differently because QuickBooks doesn't expect that you will be manipulating the amounts in here outside the normal course of events. It's presented more as a report, but regardless, it's showing the $500. Close this window, and we still have the chart of accounts open. So we're going to use the Swiss Army knife general journal approach here again. So I'm going to back the last transaction out for academic reasons to show you how to do it. As a general rule, though, you really want to avoid deleting stuff for a couple of reasons. First, you complicate the books if you do that. It'll screw everything up. And second, it's just frowned upon. So sometimes you just have to, for whatever reason, through no bad intent. So while still here in the chart of accounts, again, let's drill into the business checking account and delete the deposit. QuickBooks automatically should delete it in the job income account. Yep. Close screen, close screen. So now again, let's go over to company, drop down and click Make General Journal Entry. Close this unimportant dialog box. Our first T account choice is business checking left side. Second T account job income. Let's link this to the demo job. Click Save. Mary's $500 payment now exists in business checking and income revenue. Close this window and close this to get us back to the home screen. We still have an outstanding estimate for the construction of Mary's deck. Let's revisit the estimate we gave her, and as she has accepted the terms of the contract. So we see our price is $15,000 total with the initial down payment of $5,000. So how do we handle that? Let's take a look at the T account map first. So the flow through this is a little tricky to begin with. Then your requirement of a down payment further complicates it. And the reason, unfortunately, is that according to the double entry system, when you invoice someone, you're essentially giving them a very brief loan because it's assumed you've delivered the product. So until they pay, you're essentially playing bank. And that's what QuickBooks assumes, so it records the double entry in revenue and in the T account called accounts receivable. And most people know what accounts receivable is. That's the collection part of a big company. That's the T account where the company is playing bank. So when you create an invoice in QuickBooks, it uses these two T accounts. Now notice that one of these T accounts, revenue, assumes that you've done the work and are entitled to claim this as income. But the complication is that you haven't delivered product to the customer yet. So you've got to park that amount that is in the revenue in the temporary liability T account called customer down payment, which, by the way, is the customer actually playing bank for you. Notice that this is a second transaction that needs to happen immediately following the first transaction. Let's call that the green transaction. First transaction will just be the red transaction because that's the color I had out selected already. So now the balance in the revenue account is 0 at this time, and the balance in the customer down payment is $5,000. There's still $5,000 recorded in the accounts receivable at this time. So yeah, the funny thing is that in the accounts receivable box says that the client owes you $5,000, and then the customer down payment box says that you owe the client $5,000. But you really haven't received the money yet, so technically you don't owe them yet. But it's still kind of funny. Anyway, after a brief period of time, you receive a check in the mail from Mary for the $5,000 down payment. What do you do here? The customer down payment T account has to stay untouched probably until about the end of the job on a job like this. But the accounts receivable T account now needs to go to 0 balance because you've been paid. So now the two T accounts affected are the accounts receivable because it needs that 0 balance, and the T account called undeposited funds because you stuck the check in your drawer and went fishing for the weekend, you knucklehead. That'll be the blue transaction. And QuickBooks has an icon out from the center of the home screen called Receive Payment. That makes the double entry automatically for you. I'll show you that in a minute. Last of all, you get back from your fishing trip and you get to the bank and deposit that check. In that case, the two T accounts used are the undeposited funds and the business checking account. Notice that if a T account has equal and opposite arrows, that means it has a 0 balance. So there are 5 T accounts lit up right here, right? And 3 of them have equal and opposite arrows. So that means that there's no activity in them currently. The only 2 accounts you have to be concerned with then really is the business checking and the customer down payment. Those have positive balances. So before year end and probably about the time you wrap this deck project up, you'll have to move this value within the customer down payment back up to the revenue with a transaction. But we've got a couple of other job-related transactions that must happen first, so we'll come back to that later. So let's get back to QuickBooks and walk through these 4 steps. We're going to maintain the color coding through these 4 for clarity. So look at the bottom. See the word invoice in red? Okay, it's going to stay there through the first step. No, your screen's not malfunctioning. I put an intentional red hue here. Click on the invoice icon and the invoice form opens. First click on the customer job drop-down and find Mary's deck build job. QuickBooks is showing you the unused estimates you have available for the current customer and is asking you if you want to plop this amount into the invoice transaction. In this case, click OK and we'll play with this suggestion. So here's where you tell it to invoice only a part of the $15,000. That concept, by the way, is called progress invoicing. Scroll down to the bottom bullet and select it. And here then is the window that lets you slice off the fraction of the $15,000 estimate you're going to use for this particular invoice. So we're going to choose the Show Quantity and Rate checkbox and type in 5K. Click OK. So QuickBooks inserts the amount in the form, and clicking Save actually registers it to the two appropriate T accounts, which again are Revenue T account and the Accounts Receivable T account. Now remember, QuickBooks doesn't know if you've done any work yet to actually deserve this first chunk of money. It could potentially be an important issue at tax time, so you'll realize that as your company grows. Click Save. So email the invoice or snail mail, whatever, and you need to immediately do step 2. So remember that we kind of manually, created this T account called Customer Down Payment. We've got to move the value in revenue, the Revenue T account, to it, and realize that because this T account is custom created by us, then there is no simple and clean icon on the home screen for this task. That means we will have to use our Swiss Army knife to record the transaction, just kind of muscle it through like that. So go up to Company on the menu up top, click Drop Down to make General Journal Entry, and click. Select our custom-made T account named Customer Down Payment. And recall that it is a liability T account, so it's on King Kong side. So right side, or you can call that a credit column, of that T account is the increase of this type of account liability. QuickBooks auto-populates the other column with the same value. Now it's just waiting for us to choose an account. Choose Revenue, Income, Job Income. Memos never hurt. Now this transaction needs to be linked to a job, and we do that here. This isn't a billable transaction because it's internal. Click Save. Now let's move to step 3. This step has an icon front and center on the home screen, so click it. The form opens, and the first step is to tell it who is paying you. In other words, you first need to point to this very popular type of transaction to the customer in the job that is paying you. So QuickBooks records the amount here in undeposited funds, and since it's an asset account, QuickBooks puts in the left column of that T account and the right column of accounts receivable. All you have to worry about here is the amount and assigning it to the correct job and client, customer. Now understand that QuickBooks is not aware that your contract is for $15,000. That amount exists as a value in estimates, but has not entered this job yet, so isn't yet participating in the eddies and flows of this particular job. So simply put, bang, we're done with step 3. Notice that a red mark appears here in QuickBooks on the Make Deposit icon. That's QuickBooks' way of telling you that there is a positive value or amount in the undeposited funds T account. But we already know that. It just figures you just got back from your fishing trip and forgot there's a down payment check in your drawer. Anyway, click it and a window appears. This is showing you what is in the undeposited funds T account. If you had other checks from other current running jobs, it would list those all here as well. So just check this one. Click OK. So it now knows which job you are addressing. So now it wants to know which checking account to deposit this in. Since we only have one account, it's an easy choice, business checking. So leave it alone. Notice how it already filled in the stuff below for you. It knows what you're trying to do. So not much work involved in this transaction. Click OK, save. Now we're done with the 4 steps involved in starting up on that second job building a replacement deck. And we now need to make materials purchases using the business checking account. This is a simple transaction. So you got to buy lumber for this. Let me show you how to do that. It simply involves two T accounts, business checking and an expense account called COGS, COGS. And QuickBooks allows you several ways to do this. I'm not getting into the different ways you can do it, but the simplest way is to use the icon QuickBooks has on the home income screen called Write Checks. When you click on it, the screen appears. It's laid out like you're writing a check, and it looks like a check, but in a way, it's yet again nothing more than another way to enter an amount into two T accounts. I mean, that is the most important function of this form. After you enter that info into those fields and then click Save at the bottom. But this is a very robust software title, QuickBooks. So it's also adding some accoutrements to this double entry transaction. Like, for example, if you want to print checks instead of writing them out of a checkbook, this is the screen you create that check in. So somewhere within this form are the two places to select the two T accounts. The first is up top. Do you see business check? Okay, that's one. But then down towards the bottom, these tabs, one says expenses and the other says items. You'll be using just the expenses tab because that's where you'll find the second T account. I mean, you can use items, but most small contractors will find that the items tab way too complicated because it's meant for larger companies where you're supposed to analyze complex workflows, and you can go to either tab. It's legitimate. Items aren't part of the GAA double entry system anyway. So you will be going through the expenses tab here a lot, and you'll often use the COGS type of account for materials purchases. When you click on expenses here, the entire chart of accounts comes up. Now here's the confusing part. Why does QuickBooks have this? I have no idea, but they've done this since dirt, and I would bet it's a source of aggravation for accountants all over the world. How can the chart of accounts be a subcategory of expenses when expenses is already a subcategory of chart of accounts? It'll confuse you in the future, but there is salvation. Just hang with me for a minute. Anyway, actually I know why they do that, and it's a complicated explanation for another day. So just for now, take a Sharpie and write across your computer monitor that you'll find the second T account for this transaction with the expenses tab. Within the expenses tab. So specifically, you will be using mostly a COGS T account as the second T account used for a material purchase transaction, and specifically usually the one named job material purchased. And just real quick, as I mentioned earlier, QuickBooks assigns COGS as a subaccount of expenses, which is within equity. And here's how you enter a materials purchase. So let's fill out the fields. Start at the bottom with expense, then tab to amount, and put that in. Let's say the lumber cost $45.45. Tab to memo, type something. Tab to customer job and link this to it. Yes, it's very important to link it to the correct customer. Then click up to pay to the order of, and it's going to ask you who. Make a selection. Tab down and enter another description in the memo field. So before we click save, what is going on here? What's happening here? Did you print a check, or did you pay your ATM check card at the lumberyard with your ATM check card, or did you write a check out of your business checkbook your bank issued you? The answer is that it doesn't matter. You can record any of these transactions with this interface. Lots of people buy material and then come back, and on Friday afternoon they just pull out their receipts and record all those transactions here, one at a time. Just as long as your spending activity makes it into the books here. And if you want to see all your spending entries for your business checking account, simply open the business checking register, and there's about 4 ways to do that. So maybe you paid for this truckload of lumber using one of the checks in your bank-issued checkbooks. Click Save. So if you want to verify that this transaction is correctly entered, then get back into the check register, click this icon. It opens and you can see that the 454545 has been recorded in the business checking account. Now let's go back and look at the other T account we targeted, the expense COGS account named Job Materials. Open it up and it is shown as a report. Still just a T account though, and it shows the recording. So close that, then close the chart of accounts here. So now we've paid for the materials and built the new deck, and now we need to get final payment. What does that look like on the T account map? Remember how we have this loan up arrow recorded in the customer down payment? That we said we were going to move that back up to revenue after we earned it, so to speak? Well, that's an easy transaction to forget to do at the right time. We need to do it now because the work's done. So we need to go to the general journal, Swiss Army knife, and create the transaction that does that. So let's do that real quick. Then we'll go to get to invoicing Mary for the remaining $10,000 that she owes Jim. So this time our invoice is a little less cluttery because there is no down payment involved. The work's done, and she simply owes the company $10,000. So the first step in invoicing Mary is to choose which two T accounts we use for the transaction. They're the same ones again as QuickBooks used the first time we invoiced Mary on the demolition job that we just did for her. So again, the two T accounts that QuickBooks automatically uses when you create an invoice are accounts receivable and revenue. So reiterating the timeline on this, the first transaction is sending an invoice, right? I'm repeating myself now. How is that even a transaction except it is an acknowledgement that the work has been completed and is an official, I guess, entrance of that as a recording? So just observing that you've got your temporary loan out to Mary, which is the value within accounts receivable, is that acknowledgement. Now, the second transaction occurs the moment you receive her payment. But then when you receive her payment, it's usually a check or something like that. So you'll record that by using the receipt payment icon in the home screen of QuickBooks. So again, the two T accounts with this transaction are the accounts receivable and undeposited funds. And then finally, when you make it to the bank, the third transaction, to deposit that money or check, that event needs to be recorded in the two T accounts, undeposited funds and business checking. So this time there are only 3 double entry transactions associated with this invoice. Let's walk through QuickBooks with these 3 steps, bringing back a color scheme again. So let's go ahead and create an invoice by clicking on the icon again, choosing which job we're going to invoice for. Again, QuickBooks notices that you have a dollar value stored in the estimates memory location. Remember again that the estimate storage location is not a T account and doesn't participate in any double entry activity. But QuickBooks still has to look for any dollar value stored there, and then it offers you the option. Do you want to use the number stored here and inject it into the two T accounts associated with invoicing? So if you highlight the estimates value, then QuickBooks further asks, do you want to invoice all that remaining? And remember, this is all part of the progress invoicing system that many bookkeeping software titles offer. Those computer modules, these progress invoicing modules, they're not a natural part of double entry, but they're still governed by the double entry system. So again, here's this window asking you all about that stuff. So highlight that and tell it that we want to just dump the remaining value left in estimates into our invoice. So clean it up and click Save. Moving on to the receive payment by sliding across the horizontal line, click. This is my favorite screen here. But it needs to know who's loving me. So I tell it who. For how much? It asks. QuickBooks says, okay, I'm dropping this in the undeposited funds T account and the revenue T account because that's how I roll. I say, you're making me work, aren't you? Why can't you just put that directly into the business checking account? I ask. And it says, because you're probably not standing in line at the bank, it says. Click Save. Moving on to make deposits. Remember the red reminder on the record deposits icon saying there's something in undeposited funds? Hey, you probably need to deposit this check. So click on it, and again, the two T accounts are going to be undeposited funds and business checking. Here's our window to view everything in the undeposited funds T account. There's only one recording visible. So highlight it and direct it to your business checking T account. Click Save. Well, let's go back and view our invoice history by drilling into the Create Invoice icon. To go back in time, use the left button on top to scroll through. Notice how the word paid now appears on both of your deck invoices. Remember, we didn't issue an invoice for academic reasons for the demolition job. You customize the output of forms with this button up top. You can add a company logo, etc. It takes you online pretty much also. But then if you want to see what your output invoice looks like, go to print. And this isn't a very attractive form yet, so go ahead and fix it. Or you can email it. All right. So that's how you get through your first two jobs. And if you follow these paths, your life will be really easy at tax time. The convergence of all your correct recordings throughout the year with the power of the reports functionality is amazingly rewarding to me. And usually contractors just email their CPA the company file and let the CPA worry about it. But if you want to see some reports in the meantime on your company, all it takes is to go up top here and drill down, and there's all sorts of options to choose from. Chances are you're just going to be using a couple of these, so don't be intimidated. One very helpful hack is to use these reports to find errors in your books. You can generate reports on job activity or employee activity, etc., etc. The sky's the limit, and that becomes powerful when hunting down bookkeeping errors. So that's it for now. My name is Matt Vanderot, and you can find me in St. Louis. Good luck.